Good morning, everyone. It's time to kick off our conference. So, buenos dias a todos. It's an honor to be here to welcome you to this inaugural edition, I should say, of our Chapultepec conference. We hope this to be the first of many. This is a special gathering of very high-level policymakers in the Americas and elsewhere. I see many friends, many governors from all countries in our continent, but also from Europe. I see high-level academic participants, private sector, especially here from our host country, Mexico. So it's a great honor for me to be here in this position, starting this conference, which we think that is going to be very important for our central banking and financial community in the Americas. We have a very wide range agenda for today. I'm sure we will have a very productive journey here. We start in the morning with the macro-financial developments in this rapid pace of technological change. We have discussions on both the financial stability domain, but also on the innovation side. During our lunch session, we will have the privilege to hear from our general manager of the BIS, well known of all of us, Gaston, which will share his wisdom not only as the general manager of the BIS today, but also in his long and very successful career in central banking and finance. In the afternoon, we will discuss challenges for central banks, again in the digital era, especially regarding these sort of advancements in general artificial intelligence and how do central banks position themselves in this new era. We then will reflect on the crucial lessons learned on how central banks have navigated this very important and I should say extreme economic shock, which was the COVID-19 crisis. And our final session will look ahead, examining the main challenges the central banks in the Americas and elsewhere should be facing in the years to come. So I'm sure that this conference will be very productive. We have an inspiring agenda. We have very high caliber speakers and panelists. So I'm looking forward to the discussions today. So to begin our work, I will give the floor to Ana Aguilar, which is our host, regional advisor to the BIS Americas office, which will be she will be the master of ceremony of today's work. Thank you very much, and let's have a great conference today.
So, good morning, everyone. We are very pleased to have you here in the first edition of the Chapultepec conference in Mexico City. My name is Ana Aguilar, and I'm honored to be your host in this first edition of the conference. I have a few housekeeping notes. To keep the time, we will ask speakers and panelists to please stand by the stage before your session begins. Our team from the BIS is ready, of course, to help you with any question regarding logistics that you may have. And please be advised that photograph will be taken in the conference for internal and external communication purposes. So please smile. And finally, our conference is being live streamed. So thank you for being here, and we look forward for exciting discussion at this Chapultepec conference. And by the end of the day, we hope that we all can spell correctly Chapultepec. So let's start with our first session. Uncertainty will almost certainly will be in the top of the minds of policymakers in the Americas during 2025, and I will say in the world. And this is our first topic for today, evolving global financial conditions under heightened uncertainty. Of course, uncertainty around trade policies, geopolitical tensions, and fiscal issues across a number of economies have the potential of increased volatility in long-term rates, capital flows, and macroeconomic outcomes. Hence, financial conditions in Latin America for sure are gonna be influenced by global trends. I am very pleased to introduce our moderator for this first session, Gaston Gelos, who is Deputy Head of the Monetary and Economic Department and Head of Financial Stability Policy in the BIS. Gaston was also formerly at the IMF, so he knows our presenter, Tobias Adrian, very well, who is immediately qualified to speak in our first topic of today. Please join me in welcoming Gaston Gelos and our presenter, Tobias Adrian, to the stage. Gaston, the floor is yours.
Thank you. Thank you. Well, it's my pleasure to moderate this session and in front of this very distinguished audience. We have clearly entered we have been entering for a while already a period of high economic and policy uncertainty, partly driven by unknowns regarding trade policy, but not only. There are uncertainties that are also very important for the region, such as migration policies. This uncertainty comes against the backdrop of fiscal and debt trajectories that are very concerning in many economies. It comes also against the background of economic divergence between the US and the rest of the world. And this divergence has also been manifesting itself in longer-term yields and strengthening of the US dollar. Now, this strengthening of the US dollar in turn is likely to contribute to a tightening of financial conditions, as Anna was already alluding to, which may pose challenges to many economies in the Americas. So, in this uncertain environment with many challenges, it is particularly important to try to understand where the vulnerabilities lie. And here there is an eminently qualified speaker to talk about this. He will talk about evolving global financial conditions under heightened uncertainty. Tobias is, of course, very well known. He is the financial counselor and director of the Monetary and Capital Markets Department at the IMF. I had the pleasure of having him as a boss for a few years. And there he oversees a wide-ranging portfolio of activities. Prior to joining the IMF, he was a senior vice president at the Federal Reserve Bank of New York and associate director of the Research and Statistics Group. He has a very distinguished research record spanning macrofinance, monetary policy, financial stability, and climate finance, with a focus on aggregate consequences of capital market developments. He holds a PhD from MIT and an MSc in econometrics and mathematical economics from the LSE. Tobias, thank you for being here. The floor is yours.
Yeah, thanks so much, Gaston. And we do miss you at the fund, but the BIS is a great place. There are so many former colleagues and friends at the BIS, and also in the audience. Let me go a little bit quickly through the slides so that hopefully we have time for discussions as well. And if there's anything unclear, please do interrupt me at any point in time. So, here, so like the high level global financial stability pitch that we are seeing at the moment. So first of all, of course, the global policy environment is shifting. Monetary policies are starting to diverge. There was a humongous amount of convergence during the pandemic and the post-pandemic inflation, and there's more and more divergence. I will go into that. Fiscal and inflation concerns are putting pressures on longer-term rates, so there's a huge focus on longer-term yields. I'm going to go into that. The dollar has strengthened tremendously. This is, of course, reflecting the strong performance of the US, but it is challenging for emerging markets because, in general, dollar strength is causing financial condition tightening in emerging markets. And of course, US equity markets have strongly outperformed peers around the world. I will also go into that. Now, in terms of risks going forward, I think one risk that we're hearing quite a bit from market participants is all like, the view that US equities may be priced to perfection. So some are expressing a view that there could be a downside. Though, for the moment, certainly financial conditions globally are very accommodative. And again, I will go further into that. Secondly, we have a number of countries, in particular emerging markets and developing economies, with limits in terms of policy space. The global environment could put further pressures here. From the corporate sector, there are refinancings coming, even though yields have come down, spreads have come down, many corporates have to refinance at higher rates. So let me first talk about the heightened uncertainty, which was one of the topics for the panel, and then secondly about some punchlines for financial stability. So our growth outlook, so this is really from the WEO update in January, we see that for 25 we've upgraded the US quite notably, and China was also upgraded somewhat, while other emerging markets and other advanced economies were downgraded. In terms of the longer term trend, basically, the US is basically back to trend growth, the post World War II trend growth. In that sense, when you look at the US yields and, in many ways that is sort of like reflecting going back to like pre-GFC, right? We are at 4.5% in the US, which is back to pre-GFC. And so like trend growth is back at those levels. So, the rest of the world, though, has seen the deterioration of growth, right? You can see that in the middle chart. So this is really something that has been going on over 20 or 30 years, that medium-term growth outlooks globally have been coming down. Now, inflation is really a very positive story. There was this huge inflation surge. Inflation is coming down. Of course, price levels have not, right? So inflation is down, but price levels have not. But in terms of the way in which we think of monetary policy, there's really a big achievement. Now, financial conditions remain very accommodative. So the right chart gives you our financial conditions index. So this is really our view of the price of risk across different asset classes. And you can see there's a very slight tightening in the last quarter, but broadly it's very accommodative around the world. Despite the fact that geopolitical risks are somewhat elevated, though they haven't risen dramatically, they of course spiked when Russia invaded Ukraine, but more recently they haven't moved very much. Of course, trade uncertainty has increased, but really that has not panned out in terms of adverse moves on global financial conditions. Now, monetary policy is diverging, and that really reflects this differential performance across countries. So here I'm zooming in on four major monetary areas: the US, Japan, Euro area, and China. And basically, the N25 rate expectations have been massively upgraded in the US, but also in Japan, while they've been downgraded, meaningfully in the euro area and to some extent in China. And so this differential performance really reflects differential performance in terms of inflation and output. Inflation is coming down in the US, but it is still a little bit above target. So here we're showing you break-evens. They've come up a little bit. This is very, very much within historical ranges, so I wouldn't say there are any issues here. And Japan, of course, is still sort of like moving the underlying inflation to target, while, say, in Germany, inflation continues to drift down to some extent. I don't have break-evens for China, but of course in China also inflation has been drifting down. The CPI print, the most recently, continued to drift down. And then that in turn is reflecting growth performances to a large extent, with the US surprising to the upside, euro area to the downside, and Japan and China somewhere in the middle. So this is the divergence. Now, there's also a sort of longer-term divergence, and here I'm plotting 10-year yields for 4 countries, US and Germany on the left, and then China and Japan on the right. And so, the way I look at that is that, German and US 10-year yields were very highly correlated pre-GFC. And then with the European sovereign crisis, they started to diverge. And if anything, this divergence is becoming more pronounced. So basically, German yields are, meaningfully lower than US yields. That is, to some extent, reflective of this difference in the growth outlook. China and Japan also has an interesting development in terms of 10-year yields, and that's the opposite. They're actually converging, where Chinese 10-year yields are coming down and Japanese 10-year yields are coming up. And actually the 30-year yields have already crossed, right? I don't want to go too much into this here at this point, but of course that is reflecting, term premium to some extent, but to a large extent, so like the expected future policy path, which in turn has to do with growth expectations. Zooming a little bit more into the US, of course, US policy really matters for all emerging markets, including Latin American emerging markets. And the very, very unusual fact here, which is very different from normal monetary policy easing cycles, is that even though, of course, the policy rate has dropped since September by 100 basis points in the US, right? The long-term yield has actually increased by about 100 basis points, right? So basically the curve has steepened by 200 basis points, right? And that is quite unusual. And what I'm showing here on the left is sort of like a comparison to previous monetary policy easing cycles. And normally, when the Fed is easing, longer-term yields also go down. And that has not been the case this time, and I think I think it's important to consider this. Now, when we look at what is driving that increase in the 10-year, it's largely real term premium, right? By over 100 basis points, these real term premium have come up, again. So the 10-year yield, in some sense, is back to where it was in 2005. So the real risk premium has come up, but really it's back to 2005. It's really reflective of the fact that we are beyond the zero lower bound, secular stagnation kind of environment. At the moment, we're in an environment where growth is high, inflation is slightly above target, but it's quite different from the post-GFC era. I think it's a very important backdrop for every country to really understand this dynamic. Now, when we look at the term premia, they really have gone up around the world. So here's a sample of advanced and emerging markets in the left chart, and you can see that term premia have gone up in the US, but also in most countries elsewhere, with China being an exception where term premia have come down, which we think is reflecting a reallocation of risk from risky assets into safer assets, both housing and equities to some extent into bonds, with some reversal in recent months. Now, the right chart shows you a more regression-based approach where we ask, what is the average impact under two scenarios? So how do term premia for countries evolve, either when domestically in each country the deficit deteriorates by 1%, okay, or the spillover of US term premia to those countries increases by 10 percentage points. So that is the magnitude of increase in the spillover coefficient that we have observed over the past 2 years or so. So basically, in a causal way, so using identification, term premia are spilling over more into other economies by roughly 10%. And imagine that continued going forward. And so what we're finding is that this term premium spillover is of 10% more spillover is quantitatively similar to an increase in the deficit domestically in all countries by about 1%. And when you look across the countries, the punchline for LATAM is much worse than for other countries, okay? So that really reinforces the importance of fiscal prudence across countries. And the backdrop, of course, is one where debt to GDP has gone up everywhere, and that impacts pricing of duration everywhere. And of course, quantitative central bank policies are being unwound, so the net supply is changing, and that has an impact on pricing. So I think it's something that will remain a first-order theme going forward. Now let me talk a little bit about risks to financial stability. I'm sure you're all playing chess with your cat over the weekend. One thing, this slide has given me a lot of pause for thought or sleepless nights. So what I'm showing you, is very simple. The left chart are cumulative equity returns for the S&P 500 in green. That's basically 140% cumulative return. Japan, which is about 100% return. Europe is about half of that. And then emerging markets, and here we're breaking out total emerging markets, MSCI, versus China. And basically, MSCI, total emerging markets, cumulative returns are basically flat since 2019, right? That is quite dramatic, right? That really is extending a longer-term trend. So the middle chart goes back to 2010, where we just show the share of world equity market capitalization. And so the US market cap has gone from 30% in 2010 to 50% as of now, right? And so the reasons are outperformance, which is very closely tied to the Magnificent Seven and technology, is not that unusual in the longer term, right? So I think this is quite important, and you can see that the share of some other countries have been coming down. Now, when you look at LATAM, which is pointed out there, the share has also come down quite meaningfully, right? So I think it's something that really is important to reflect on. And so the right chart is thinking about valuations in equity markets. And so there are many different ways to think about valuation. So what we're doing here is to ask about what is the growth forecast from analysts. That's the green bar. So basically, US earnings growth has continued to be, very, very strong. Emerging market earning growth is actually pretty strong. And other advanced economies, is also strong, though not quite as strong as the emerging markets or the US. But basically, when you then ask in terms of valuation, so price-earnings ratios, what would it take to come back to historical levels of price-earnings ratios? Basically, EMs don't need any earnings growth, so they are already at the historical average. Advanced economies are basically, going to be there, whereas the US, has somewhat stretched valuations. And so this is where, when we talk to market participants, there's some divergence of views as to, how much risk that represents. Dollar strength is tightening financial conditions. We have seen since last September, since the Fed started to ease, we have seen the dollar rally. Of course, long-term yields have come up, and equity markets have rallied very strongly in the US relative to the rest of the world. So both yields going up and markets rallying has contributed to dollar strength. And of course, that does mean financial conditions are tighter, and that is more so in EMs, that's the right chart, than for the rest of the world. So emerging market monetary policy, is somewhat constrained by that, right? So basically, inflation on average is sort of like back to target. Again, there's heterogeneity, but when you look at LATAM, Central Europe, Eastern Europe, Asia, advanced economies, you're basically back to target. So the inflation episode is behind us. Of course, the price levels have not converged back. But you can see that the EM policy rates are at quite higher levels, right? And part of that is reflective of differentials. So the differentials are higher. And part of it is these higher term premia, as we have seen earlier, right? And so, how do you think about, R star plus the term premium? I don't know that R star has come up, though that's debatable, but term premium have come up for sure. So that's problematic. Now, here's the other chart that sort of like keeps me awake somewhat at night. Here we are looking at cumulative equity returns on the left chart again. This is just zooming into Latin America. And you can see that there's a divergence across Latin American countries. But again, the US is sort of like, strongly outperforming all of these major LATAM EMs. But then when you look at the sovereign bond returns, and here you can look at either local returns or dollar returns, it's quite similar. Basically, this is just pulling the Bloomberg, cumulative ex-post bond return from indices. You can see that for LATAM, basically, those returns have been flat, and both US high yield and private credit have strongly outperformed, right? And so here again, I think it gives me quite a bit of pause for thought in terms of, the cost of capital going forward. Now, associated with that observation really is the fact that local currency bond markets, right, they've seen inflows, but the inflows have not kept up with the issuance of local debt markets. And developing local debt markets is a huge priority for every country, and we are working with many countries to develop local debt markets. But basically what we have seen, and that's shown in the right chart across the range of emerging markets, basically the share of foreign investors in those local debt markets is actually coming down quite dramatically, right? And that, again, is giving me quite a bit of pause for thought in terms of how to think about sort of like capital flows, investments going forward. Now, this is the final slide, 13, on corporates. Basically, corporate spreads are historically tight. And sovereign spreads are also quite tight, right? So in that sense, financial conditions are very favorable. But of course, the base level of rates is higher. And so, corporates globally have to refinance, and they had locked in those low rates, and they are expected to have to refinance at higher rates. So that will put some pressure on the corporates. Now, of course, growth remains strong. But monitoring sort of like corporate performance is key. In private credit markets, we see that payment in kind. So this is all like reprofiling of debt. The share of payment in kind is going up. This is looking at the US, a private credit universe. And so we are monitoring the credit quality very closely. Of course, in private credit, we have seen this extraordinary performance. So now there's a lot of capital allocated flowing in, and so making sure to understand what is happening to underwriting standards as there's more capital allocated to the space is very first order. So let me stop here.
Thank you very much, Tobias, for this tour de force. We have a few minutes for questions. Agustin, please.
Do I have to shout now?
I can hear.
Thank you, thank you. Well, thank you, Tobias, for this great. This is on. Do you hear me? Yeah, for this great presentation. I have two questions. One very pointed one, quick answer. The impact on the risk premium of fiscal deficit on Latin America is quite large, and I certainly would sympathize with that. How much is that affected by a few countries? I mean, Argentina, probably Brazil. That just sort of reinforces the message, but I just was curious. And the second, I think, a little bit more broader. I mean, I fully agree with all the warnings you are issuing here. You're pointing out they're very good. Now, also what we have seen during the last 2 or 3 years are bouts of extreme global volatility in markets, like situations where sort of markets break down. Obviously many of them associated with probably the trend towards increasing interest rates, and so on and so forth. But then, I have the sense that there is something there that we might not be fully seeing. For example, when the carry trades break down and the amount of volatility that spurs, and certainly that has an important impact on Latin America. So what are your thoughts on how do you conceptualize, is this going to increase in the future where we will have more bouts of extreme volatility, or is something that was concentrated in the recent past because many central banks adjusting their monetary policy stance? So those are my questions. Thank you.
Do you want me to? Okay. Excellent questions, of course, Agustin. So let me start with the first question on the term premia in Latin America. And you're right to point out that there's, of course, quite a bit of country heterogeneity, and I showed you some of that. So you asked specifically about Argentina and Brazil. Of course, Argentina has seen a tremendous fiscal adjustment, and you can see the benefits of that fiscal adjustment in the pricing of debt. In Brazil, when we look at our yield curve decomposition, we actually do see term premium coming down in Brazil, unlike the other Latin American countries. So we think that yields going up is a little bit more related to monetary policy expectations there, according to our decompositions. But of course, I would be very curious to hear from the Brazilian governor as well on this issue. In the other countries, we do see this broad rise in term premia alongside advanced economies, as I showed you. And that is really reflective of the fact that, globally, sovereign debt supply has been increasing. Central banks have been ratcheting back their balance sheets, so the net supply in private hands has been coming up. So it's more like a normalization since the pre-GFC, but it is certainly something we watch very closely. Secondly, in terms of bouts of volatility, so markets are adjusting to news. So there's sort of like natural base level of volatility. When we look at equity market volatility or interest rate volatility, rate volatility was somewhat elevated. It's coming down to some degree. And equity market volatility is around historical averages. But of course, there are these bouts of volatility. And the question is, are there sort of like nonlinear amplification mechanisms? Are there some sort of like, hard to detect derivatives positions, for example? You mentioned the carry trade. I think the unwind on August 5th last year is very fresh in our minds, and that had spillovers to emerging markets, for example, in Latin America. So I would say three things here. So number one, we did see in August very quickly market players with longer-term investment horizons coming in very quickly. For example, in Japan, the insurance funds and pension funds, came in a stabilizing fashion. Sovereign wealth funds often come in as well in a stabilizing fashion. So, while there might be unwind of levered trades sometimes, you do have these longer-term investors as well. And, that is one stabilizer. I think the second stabilizer are the central banks. Clearly when financial conditions tighten in a manner that has macro implications in terms of macro downside risk or the macro baseline, then of course the central banks are going to adjust in terms of injecting liquidity. And again, when you think about the August 5th episode, certain central banks, quickly came in with statements. There was no policy change, but there was certainly an adjustment in communication. And I think central banks are very attuned to the fact that financial conditions play a major role in terms of monetary policy transmission. Many central bank governors acknowledge that. In the academic literature, this is sometimes referred to as financial conditions targeting. And then finally, I would really underline the importance of financial regulation. We are in a world where banks have more capital and more liquidity. I think we have done also a lot of advances over the past 15 years in terms of having a well regulated non-bank financial sector. So I do think the baseline in terms of financial stability from a regulatory approach has really improved, and that is very important in terms of being able to absorb adverse shocks. So I think the potential for nonlinearity, of course, there are lots of potentials, but having the core financial institutions being well regulated, is really important in our view.
Thank you, Tobias. I'm afraid that we have reached the end of our session. Please join me in thanking Tobias for his presentation with a round of applause.